say the least. Even if you look at BYD, which really focuses on not only EVs but also hybrids, their margins are very, very low. I mean, you're kind of looking at the same type of ICE type of margins where there could be between 4% to, let's say, 8.5%, 9%. So they have to churn out more vehicles or sell more vehicles in order to be profitable here. That's a little bit different than what we see from Tesla, which Tesla has probably the highest margins in the EV space here. So they don't have to sell as many cars in order to turn a profit. But once again, we see these price wars happening in China and even in the Eurozone, and that's putting pressures on margins across the board here. So NIO definitely has a significant amount of market share, but once again, they're just not up to the production level yet to turn consistent profitability here in the near term.
Decline, competition, and potential. Looking at NIO's recent stock performance, it's evident that the company is facing significant challenges. With a 90% decline from its peak in early 2021, NIO's shares have been tumbling, nearing lows not seen since 2020. Adding to the pressure, JP Morgan's recent downgrade has further dampened investor sentiment. But should NIO keep dropping to end an impulse structure? NIO recently hasn't been having the best time in the stock market. Its shares have been facing a downturn, making it a bit shaky for potential buyers. The outlook for NIO stock in the near term seems murky, earning it just a D grade for now. There's a glimmer of hope on the horizon with an important event scheduled for early March. However, investors are advised to temper their expectations as significant positive catalysts for NIO have been few and far between. NIO is a major player in the electric vehicle market, focusing on designing and developing EVs. The company stands out with its innovative battery swapping stations, offering an alternative to traditional charging setups. With over $5 billion raised from investors, NIO has ambitious plans to expand its presence to 25 different countries and regions by 2025.
We'll have to wait and see. They've also, got their own independent manufacturing license, and this is also key for them to take control of its own production. They don't have to pay, rather large fees to the likes of JAC Motors to produce their EVs in future. So there is some hope for the future that by taking control of its manufacturing, getting a better grip on costs and bigger partnerships with its business, that it can look towards a brighter future.
Now, have you heard how investing company JP Morgan recently downgraded NIO stock? It's a significant move, reflecting the challenges facing the Chinese electric vehicle maker. Due to various factors, NIO stock has been tumbling, nearing lows not seen in 4 years. These include supply issues, weak production forecasts for other EV companies, and fierce competition in the market, particularly from rivals like Tesla. The recent announcement of workforce cuts and concerns about slow sales in January have only added to the downward pressure on NIO's stock price. JP Morgan's downgrade highlights the low earnings visibility across the Chinese auto industry, with concerns about NIO's ability to meet volume and revenue estimates. The lack of new models relative to its peers and the intensifying competition in the mass market are also contributing to the negative outlook for NIO's stock. Looking ahead, JP Morgan forecasts NIO shares hitting $5 per share, significantly lower than the previous price target of $8.50. However, Morgan Stanley remains optimistic, with an overweight rating on NIO and a price target of $13 per share. According to Morgan Stanley, the key lies in NIO's execution, particularly in leveraging its sales team and focusing on key areas like battery swapping and ADAS development. Meanwhile, the Elliott Wave Forecast team has analyzed NIO's daily chart from February 2024, revealing market movement patterns. Initially, NIO experienced ups and downs, with Wave I reaching a low of 11.67 and Wave 2 bouncing back to a high of 24.43. The market then descended in 5 waves, with Wave 3 forming a low of 7.33. After a corrective phase, NIO saw further declines, with Wave 1 reaching 9.46. This pattern continued with subsequent waves, indicating fluctuations in NIO's stock price. Investor Chris McDonald also weighed in on the shifting perspective regarding Chinese EV manufacturer. While acknowledging the relative upside potential for NIO's competitors within the EV space, McDonald highlighted reasons why investors might still view NIO as a strong long-term investment. McDonald maintained that many bullish arguments supporting NIO's stock remain valid despite its challenges and increased competition, particularly for those with a long-term investment horizon. He emphasized the complexity of valuing NIO due to its growth potential and competitive pressures, but suggested that the stock's volatility could present intriguing opportunities for investors. Moreover, McDonald discussed the strategic partnership between NIO and For7 following a significant investment from the Gulf nation. This collaboration involves technology licensing agreements and strategic investments, indicating NIO's innovative approach to global EV development. In addition, he highlighted NIO's participation in a Danish pilot program, where its battery swap stations contributed to maintaining grid stability during periods of high demand. According to NIO's Senior Vice President Shen Fei, this information was revealed on China's social media, Weibo. Currently, NIO operates 39 swap stations in Europe and plans to open more in China, indicating significant revenue potential. Shen emphasized the revenue generation potential through European grid frequency regulation services and the impact of NIO's battery swap model on grid infrastructure and renewable energy integration. He also discussed NIO's involvement in grid load regulation, estimating considerable electricity cost savings. Despite recent underperformance, NIO's price-to-sales ratio suggests it's one of the best-valued stocks in the EV sector compared to US-based companies. This presents an attractive opportunity for long-term investors, contingent upon NIO's ability to scale production and profitability. The competitive nature of the EV market, particularly in China, warrants caution, prompting some investors to remain on the sidelines for now. But before we move on, we just want to thank you for watching this far. Now, is NIO a buy, a hold, or a sell? Despite a staggering 90% decline in its share price from its early 2021 peak, NIO's business performance has been stronger than this decline would suggest. While concerns about China's economy persist, NIO's expansion into international markets, including Europe, and its plans for the United States offer potential avenues for growth. The company's recent sales data paints a positive picture, with January deliveries showing an 18.2% year-over-year increase and Q4 deliveries up by 25%. Additionally, NIO's presence in China's rapidly growing EV market, where new energy vehicles accounted for over 40% of purchases in November, indicates long-term potential. Despite its revenue nearly quadrupling, NIO is yet to turn a profit, a common scenario for businesses investing heavily in manufacturing operations. However, with continued growth in output and sales coupled with a healthy cash reserve of $6.2 billion, NIO's path toward profitability seems plausible. Comparatively, NIO's price-to-sales ratio is the cheapest among its competitors, like Tesla, Rivian, and Lucid. However, uncertainties persist, including the possibility of another income-negative quarter, leading to a cautious D-grade rating for NIO stock. Investors should weigh these factors carefully before making investment decisions. But always remember, investing in stocks like NIO requires thorough research and consideration of various factors. While NIO's recent performance and potential may seem promising, it's essential for you to dive deeper into the company's financials, market trends, and competitive landscape before making any investment decisions. Conducting thorough research can help you make informed choices and mitigate risks associated with investing in volatile markets. So, do you think NIO is a buy, a hold, or a sell? Share your thoughts in the comments section below. And that's it. Make sure to smash the like and subscribe buttons down below. Additionally, if you want to know if NIOs will rebound this 2024, just click this video right here. We will also be releasing a video discussing NIO's recent earnings report and what analysts and investors think about NIO's future in the market. Thank you for tuning in, and stay tuned for more exciting content in the future.